This is the 2-minute version about how a venture capital fund works. Actually works like this. A few people called partners decide we want to work in startups. We want to invest in startups. That could be a banker, it could be a VC, it could be an entrepreneur. We really want to invest in startups. So we want to do a VC fund. And to have enough money, we want to have a VC fund of a certain size, and that could be $100 million. But guess what? The three of us don't have enough money to invest in $100 million. So we go to someone who has a lot of money. We go to a pension fund. And we say to the pension fund, hey, let us invest in a VC fund that will last for 10 years. And in those 10 years, the first 3 we will invest, and after that we will harvest. And our goal is that the $100 million, we will multiply that with 3. So dear pension fund, you will get $300 million out. So we have this $100 million, we're all happy now. We could invest that in a lot of different ways. We could invest it in 2,000 startups or 2 startups. Most of us decide to say, well, we invest in a limited number of startups, say 20, because we only are 3 and we have to take an active role in that. So we actually saying, well, we need a number of startups so we have enough, so representative, but not 2,000. And if you look at the statistics about these 20, how they will end. In early stage venture, actually approximately 50% of them will just die. Then you have some will be so-so, where the VC fund will maybe get the money back. But in real life, it's 1 out of 10. So in this case, 2 startups they will really make money on. And actually what you then will realize is that what that have an implication for a startup. Because we have promised the pension fund to return 300 million. So that will basically mean that we want to get 300 million out. So, but the problem is the venture fund does not own the companies they invest in. Maybe on average they invest and own 20 to 25%. So assuming that we have a 25% stake, that actually means that we need to have an exit value of 1.2 billion to be successful. Again, we only own 25%. And assuming that that is mainly covered by the 2 startups there, that basically means that each of those successful startups we will be going to look in will need to have an exit value of 600 million. So if you're a startup and want to be an interesting or potential case for VC fund, you need to be able to make it really, really big. And that is basically how a VC fund operates, and why a VC fund operates in a number of small companies. They need to give the money back to the pension fund early on, and you're only interested if you can make it really, really big. Cool, thanks.